This conference will now be recorded.
So, good evening, Swastik, and welcome back to a fresh new session in market risk modeling. So, welcome back to a fresh new session on market risk modeling, and we have been talking about the basics of market risk regulatory frameworks, the BCBS and the FRTB guidelines. So, the way the discussion is kind of proceeding on right now. So basically, the way the discussion is proceeding right now, what we are trying to do is we are trying to talk about the we are trying to talk about the two, so we are trying to talk about uh, the the domain of market risk in two different aspects. So one of the aspects that we are talking about is in terms of the quantitative methods, and another strand of discussion that we are taking up is the BCBS and the FRTB guidelines. So on one side, we are trying to develop that technical toolbox that we need for model development, and the next that we are trying to develop is the BCBS, the regulatory guidelines. So we are trying to do these two things. So that is something that we are trying to do. Now from here, so while I define market risk, so market risk is defined as the risk of losses which arise from the movements in the market price of the assets. Now the question is, when I talk about the market assets, there are different kinds of assets which are getting traded, and that there are different sources of risk that we need to address, right? So there are risks arising from the trading book instruments, and there are risks arising from the banking book instruments. So over here, our broad focus will be on these key sources of risks, right? So we will be talking about the trading book risks as well as the banking book risks. But basically, what we do is we'll first of all we started off our discussion by introducing the difference between trading books as per the Bank of International Settlements. So basically, when we are kind of trying to define the trading books, we need to define it in a specific manner. So what is that manner? So that is, so over here we are trying to define the scope of the trading book instruments. So the instruments which comprise of the financial instruments, foreign exchange, and commodities. So the first thing is, when we are defining the trading books, we define it in terms of the scope of the instruments, right? And we talk about the standards for assigning the instruments to the trading book. So basically, what should be the type of the instruments, and then the next thing that we talk about is what are the standards, or what are the characteristics that must be assigned for to the so what should be the characteristics for assigning instruments to the trading books, right? Now over here, the scope of the trading book instruments. So the first thing is, the instruments that we are talking about over here are the instruments which are financial instruments, foreign exchange, and they are foreign exchange and commodities, right? Now, the next thing is that I can only be introducing these instruments into the trading books if there are no illegal impediments against buying, selling, or fully hedging it. That is, this asset is freely tradable market assets, right? And the banks should fair value their daily any trading book instruments and recognize any valuation change in their profits and losses. So that's the basic idea of this trading book instruments. Now, the next question that comes out over here is that what are the standards for assigning the instruments to the trading books? So, any assets that are held by the bank for one or more of the following purposes, right, is called for incorporation into the trading books. Now, basically, if an asset has to be incorporated into the trading book, so it has to be freely tradable asset market. So it has to be freely tradable in the asset market. Now the question is that if it has to be freely tradable in the asset markets, what are the conditions for doing that, right? So it is that any of the instruments, in addition to the conditions, so basically there has to be the following purposes, right? So first is there is a short-term resale, there is a profiting from the short-term price movements, there is locking the arbitrage portfolio. So basically, if we look into when we looked into each of these conditions, what we saw was that these assets are, so when I talk about an asset which is a freely tradable asset, right? So one thing that I see is that yes, there is a short-term resale, so it can be sold in the short term. The second thing that I see is that if I can sell it in the short term, then what I can do is I can make profit from the short term price movements, right? The second is locking in the arbitrage portfolio, right? So there is a locking. So what I'm trying to do is I'm trying to lock in the arbitrage portfolio. So I must be in a position to have an arbitrage. I can arbitrage the asset. So basically, if there are two individuals who are buying the asset, it should be possible for me to bring it in a position where the demand for this equals the supply, right? So over here, this is something that we should that we can do over here, right? So this is something that we can do, or this is that we can. So these are the characteristics that we would have. Now, so basically, if you look into the characteristics of these four characteristics taken together, so the basic conclusion that you come to over here is that all these four characteristics taken together ensures that your asset is a freely tradable asset, because if your asset is a freely tradable asset, it should give you a so it should give you the opportunity to do a short term resale. So you should be in a position that you can actually buy and sell the asset in a short term. The second is you should be able to profit from the short-term price movement. You should be in a position where you can profit from the short-term price movement, right? So the next that you have is locking in the arbitrage portfolio, right? So locking in the arbitrage portfolio, and the next, so that is I should be able to arbitrage that asset. The next is hedging the risks that arise from instruments which satisfies the conditions above, right? So I must be able to hedge the risks that arise from the instruments which satisfies these conditions above, right? So for an asset to be applicable into the trading books, that asset should be a freely tradable asset, and its risks should be and it should be in a position and should be able to hedge the risks, right? So that is something that we would want to do over here, right? So that is something. So that is obviously one of the standards for assigning the instruments to the trading books, right? Now comes the next question. So the next question over here is that any of these instruments, in addition to the condition mentioned above, right? If it is seen being held at least for a set of conditions, that should also be a part of the conditions or requirements for that asset being used as a tradable asset. So what are the conditions? So if it is held for, number one, instruments in the correlation trading portfolio, right? So instruments is a result of the underwriting commitment, and instruments are managed on a trading desk. So these are the three characteristics that must be shared, or that must be there for one to use these assets, right? So over here, so these are the three things that we generally would look at, right? The instruments in the correlation trading portfolio, the instruments, so that the instruments are instruments in a trading portfolio. So basically, you have, let's say, you have a wide variety of stocks and wide variety of assets which are invested into, and that there is a correlation, right? So basically, what type of a correlation am I talking about? Let's say you are a person who actually invests into an umbrella stock, into the stock of an umbrella company, and into that of a garments company, right? So basically what you do is during the summers you invest into the stocks of the government, and during the winters you do it for the umbrella company, so that when the summers come in, you earn a return from the umbrella company, and then when the winters come in, you earn a return from the from the garments company, from the company creating garment winter garments, right? So over here, one thing that we get to see is we get to see these kind of so those assets must be such kind of a trading portfolio. So you must have instruments in the correlation trading portfolio. Now, similarly, the instruments is a result of the underwriting commitment. So the instruments is a result of the underwriting commitment. So basically, there has to be a proper underwriting process for these instruments, and these instruments must be traded over a trading desk, which vis-a-vis implies that set of conditions one to the four criteria laid down in condition one is also satisfied. Right. So these are the definitions. So these are the characteristics that you must have for an asset to qualify for the trading books. Now the question that comes out over here is that how do we assess this characteristic? So how do we assess this property or this characteristic over here, right? And how is it that the assets that are held by the so how is it that okay, and so how is it that these assets become different from the banking book assets? So before we, so the next thing that we need to understand is that what exactly are the differences between a trading book asset and a banking book asset. So let's try to assess that. Right. So the first thing is that what exactly is it that a trading book asset does? So a trading book asset is to be traded daily, right? So therefore, the assets are to be marked to the market on a daily basis, like which is not necessarily the case for a banking book asset. Like so, the assets are not marked to market on a daily basis, right? And assets which are on the banking books, right? They are actually held at their purchase price. So what is this? What are these assets that you are holding at a purchase price? Let's say you have a 10 years government bond or a 30 years the central bank bond. Now these are not market assets. You are not trading these assets to make to earn profits. What you are doing is you are kind of holding them for interest based purpose. So you don't need to mark them to the market every day on a daily basis. But for an asset which is onto the trading desk, that has to be marked to the market on a daily basis, right? So similarly, on the other, so for the banking books, these assets are not marked to market daily, but they are generally held at their original price. They are held at their own purchase price. So this is one of the biggest difference that you have between an asset which is on the trading book and on the banking book, right? So they are held at their purchase price or they are held at their book value. So let's say, for example, one of the asset on the banking book is a personal loan which they have, which the bank has actually lent out to the bank has actually lent out. So let's say so you have an asset which is like so you have an asset which is on the banking book, so which are not marked. Sorry. So the assets in the trading books have so think about it this way. So you have a personal loan which has been taken on the books of the bank. So it is maintained at fair value or at the book value of the loan. So the book value of the asset, it is maintained in the books. But if the bank has certain shares or investments in certain assets, then that is marked to market on a daily basis, because those assets will be traded at regular intervals, on a regular basis at very small time intervals, right? So that's something that we need to do. Now from there comes the next part, that we say that the assets, the next thing is that the assets in the trading books have their value at risk measured at 99% confidence level on a 10 days time horizon. So basically what we generally do is, for assets which are on the trading books of the bank, we measure the value at risk at a 99% confidence for a 10-day interval. So we always try to see the 10 days VaR. So in the 10 days, within 10 days, what is the amount of risk, that what is the exposure that you can, the maximum exposure that you can lose. So that is 99% confidence on the 10 days basis, right? Now for the assets which are on the banking books of the bank, so which are on the banking books, they are measured at 99.9% confidence at over a 1 year horizon, and this precisely marks the, so this marks the total loss that the bank can generally earn. So what is the total loss from the asset? So that's the 99.9% confidence part, right? Okay, so let us try to start off with the basic descriptions of the difference between the asset. So differences between the trading books, the the banking books. Okay. So the first point that I have over here is, the first difference between trading books and banking books. It's the mark to market price, and we call it the MPM versus book value. Okay, the mark to market versus the book value. So the first point that comes over here is, the assets in the trading books are marked to market on a daily basis. So obviously the next question that comes out to us over here is that what exactly is this mark to market. So how do I define the mark to market price, right? And how do I define the mm, you know the book value market basis while the assets on a banking book is maintained on a maintained at a book value. So it is maintained at a book value. So the question that comes out over here is that how do I define a book value and how do I define a mark to market? Right. So how do we define the mark to market while the asset on the banking book is maintained at a book value? So how do I define these two concepts? Right. Okay. So over here, uh, we need to understand each of these two concepts. So the two concepts can be explained as follows. Can be explained as follows. So now, while I say that these two concepts can be explained as follows, the first question is, what is a mark? What is the marked value? Like, what is the market value of an asset? And the other is what is the book value of an asset, right? Or let me write it like this to explain the two concepts. To explain the two concepts, we need to define the difference between a market value of an asset, the market value, and the book value of an asset. An asset is to be taken, is to be explained. The first point that I have is the market value. Okay. So the first is the market value of an asset. Now, how do I define this market value? So this is the value of an asset which is based on the traded prices, which is based on the traded prices in the financial markets. There is a value of an asset which is based on the traded prices in the financial markets. So the first thing is, the first and the most important price over here is, this is not the price at which the asset was initially booked or whatever the book value of the asset is. So this price of the value, the market value of the asset, is based on the traded prices in the financial market. So this is the value of an asset which is defined by the demand and the supply, right? Okay, this is the value of an asset which is based on the traded prices in the financial markets. Okay, so before we proceed, Swastik, just give me a minute's time and we'll reconvene after that. Just give me a minute. Hi, sorry. Sorry. Okay. Sorry, Swastik. Something came up from the website, so I had to just address that. Anyways, let's move on. So as I was saying, the market value of an asset. So this is the value which is based on the traded prices in the financial markets. Right. So this is the value of an asset traded, so which is based on the traded price of the financial market. So that means this is driven by the excess demand and the excess supply of the asset in the financial market, right? So through the so though the market value can be calculated at any point in time, so typically get to know the this value of an asset can be calculated at any point of time, right? Unlike the book value, because the book value is only observed when, so is only recorded when the earnings are observed, right? So because a book value is generally derived from the cash flow that the asset actually generates, right? So over here, let's try to look at it in two different ways. Number one, the first is, so when I say a market value of an asset, so it means that the assets are marked to the market value. That is, it is marked to the value of the asset, which is based on the traded prices in the financial markets, right? So similarly, the book value of an asset, right? So the book value of an asset is the following. So this value of a financial asset is derived from the cash value, from the cash, not, I'll not use the cash value, but the cash flows generated by the underlying asset, right? So this is the first, and so this is the most important point. So this is the basis of the book value, right? So the book value can be defined as the the net cash flow, or the, or the cash flows which are generated by an asset. So let's say I want to assess the book value of a loan, right? Of a personal loan which has been given. Now this personal loan will generate a cash flow. It will generate a contractual cash flow over a period of time. So when I look into the discounted cash flows, I'll say that okay, this is what the book value of the asset is. So of the loan is. So similarly, if there is an equity, that equity will have a dividend cash flow, will have a flow of dividends, the future flow of dividends. I look into the net present value of the future flow of the dividends, and that will be the book value of the asset, right? So the book value, the fundamental value of that asset. The market value of the asset can be above or below the fundamental value, right? And that's why assets which are the banking book assets, they are held at the book value, and the other assets are marked to the market, right? So this value of a financial asset derived from the cash flows generated from the underlying asset, right? Okay. So unlike unlike the book value of an asset, so unlike the book value of an asset, unlike the market value of an asset, which can be calculated at any point in time based on the existent excess demand and excess supply of the asset, based on the existent excess demand and excess supply of the asset, the book value of an asset can only be known. The book value of an asset can only be known when its earnings are observed, when the earnings or the cash flows from the asset can be observed. observed. Okay, now the next part is the value at risk. Okay, so basically the first point that we said is that the so the first is that the trading books are marked to market on a daily basis, while the banking book is maintained at the book value, right, or the actual prices. Now comes the difference in terms of the value at risk, right? Now, while I talk about this particular part, this choice of this value at risk is actually very different. So it's actually very important. We need to understand how exactly this value at risk is used both in the banking books and how is it used in this trading books, right? So basically, first of all, so even though I know that we all know what a value at risk is, let us try to define that once, because this value at risk is actually going to play a very important role in the market risk. So in the later discourses about market risk, so we are going to come to that part, right? So let's try to see that. Let's try to discuss that part. The first is that, so because value at risk is such a critical measure of riskiness, it gives us an idea of the total loss that is impending, right? Okay, so let's try to first define value at risk. Okay, and then we'll talk about the difference. So the question that comes over here is, what is value at risk? So value at risk is a statistical measure of the riskiness of the financial entities or the portfolio of assets. So it is a measure of the riskiness of the financial entities or the portfolio of assets. So it is kind of a percentile measure. So as we know that it's a percentile measure which tries to show us that what is the maximum possible loss that you can earn if you were to use. So what is the maximum possible loss that you can earn under a certain given confidence, right? that, so what is that maximum possible loss that can be earned over a given horizon with a certain given confidence. So this is basically a kind of a percentile measure, or it is kind of a relative measure which gives us an idea about the losses, right? So so this measure is a measure which helps us or which gives us an idea about the total loss that possibly can be earned, right? So this measure gives us an idea about the probable amount of losses that can be earned over a period of time, or the maximum losses that can be generated probable total losses over a period of time, right? So this is something that we need to study. So now the question that comes out is, how is it that this measure gives us an idea about the probable total losses that can be generated over a period of time, right? So let's see how this, so let us try to define this or quantify this definition. So let us try to quantify this concept. This concept. So what is this? So it is defined as the maximum dollar amount expected to be lost over a given time horizon. So it is defined as the maximum dollar amount expected to be lost over a given time horizon at a predefined confidence interval. At a predefined confidence interval. Right. So over here, so this is the way I'm trying to quantify the total losses that I can make. What is the total losses that are probable to be made, right? At a predefined confidence, at a predefined confidence level, right? So for example, so let us see how is it that we are doing. So basically, whenever we are defining VaR, we are defining it over a period of window, right? So for example, so let's take a very basic example and we say that. So if the 95% 1 month VaR is 1 million, so suppose the 95% 1 month VaR is $1 million. There is, so if we say that suppose 95 by 1 month is 1 million, then it implies, then it means that there is a 95% confidence. There is a 95% confidence that over the next month the portfolio will not lose more than $1 million. So this measure provides this measure provides uh, so this measure provides an upper cap of the losses that the portfolio can earn. Provides an upper cap of the losses that the portfolio can earn. Right? So there is a 95% confidence that over the next month the portfolio will not lose more than $1 million. So this measure provides an upper cap of the losses that upper cap to the losses that the portfolio can earn. So I'm not going to lose more than $1 million. So that is what is precisely said over here. Right? So this is the I believe this is the way you also use VAR in your day-to-day operations. So the interpretation would remain the same. Now, while I talk about this VAR, right? So one of the important questions which crops up is that how do I econometrically predict that VAR? So over here, while I talk about this VAR, and I will be using this VAR to define the to discuss the difference between the trading books and the banking books, right? So while I define this VAR, so basically the question that will come out over here is that question. So an implicit question over here is that I am doing my I always calculate my 10 days VAR, right? So I'm trying to always calculate my 10 days VAR, and I'm trying to say that okay, this is what the next 10-day VAR is, and like this. So what if? So based on the last 10 days of result, I can actually try to capture, okay, this is what the 10 days VAR look like. Now let's say if I have a series of VAR values, the question that comes out is, can I go ahead and can I predict that value of the VAR? So is it possible for me to econometrically predict or to econometrically try to predict this value at risk, right? So and if that is possible, then how do we do that? So that's the next question that we will come so that is the next question that we will come to, right? Okay, so let's try to get this done. Okay, so this measure provides an upper cap of the losses that the portfolio can earn, right? So therefore VAR is a concept related to the total loss. So the next part that we have over here is the banking books and the trading books. Trading books can be defined on the basis of their approach to use the concept of the value added risk, the value at risk. Right. So the question is, how does trading books use this VAR? So the assets in a trading book, and let me put it down this side. What are the assets in a trading book? Have their VAR for assets measured at a 99% confidence level. So the assets in a trading book have their VAR for assets measured at a 99% confidence level on a 10 days horizon. 10 days horizon. So basically, it says that we are 99% confident that over the next 10 days, will not be losing more than so and so dollar or something. Right. So the loss that that you can possibly earn or you may not possibly earn is dependent on the distribution of the value at risk. Right. So on the other hand, of the banking books, the assets on the banking books, on the other hand, is measured at confidence interval on a 1 year horizon. So while it does it on a 10 days horizon, the assets on the banking books is measured at a 99.9% confidence interval on a 1 year horizon. Right. So these are the two broad differences that we can think about a banking book and a trading book, and this. So if you think about this VaR, this 99.9% VaR is the total loss that a bank earns, the total credit loss that a bank earns, and this is the one that we calculate using the we calculate using the Basel frameworks, right? So so this VaR on the bank, the VaR of the banking books, VaR of the banking books at 99.9% confidence interval. So confidence interval is the total loss, that a bank earns. Right. So this is used to compute the unexpected loss of the so this is used to compute the unexpected loss of the right. So let us see the equation. So loss of the bank, which is as follows. So the total loss is equal to the expected loss plus, or as we call it, the EL, plus the unexpected loss, or the UL, right? So the unexpected loss over here is, or the UL is equal to the total loss, or the TL, minus the expected loss. Right. So therefore, the unexpected loss is calculated as the VaR 99.99% confidence minus the expected loss. So therefore, the unexpected loss is captured from the total loss minus the expected loss. Now, in credit risk, that is the reason why we develop this PD, LGD, EAD models to calculate this expected loss, and from there it is subtracted from the total loss to get the unexpected loss. Then to that unexpected loss, you keep aside 8% of the unexpected loss as the capital, and to that you multiply 12.5 into the exposure default, and what you get is your RWA. So that's the capital charge that you keep against your credit risk, right? So this is the easiest part of so that's the the beauty of credit risk, because with credit risk you just have only one sort of risk, which is the default risk, right? And you are developing the models on or capture that default risk, the loss given default and the exposure default, and you are sorted. However, when you are doing market, so whenever we are trying to calculate the capital charge against market risk, the sources of risk for a market risk is a bit different, right? So it's very different out there, and that is the part that we need to look at. So basically, from this definition, from this differences between the trading books and the banking books, we could see that the biggest difference between the two is in terms of the mark to market versus the book value, the way the assets are marked. And the second that we have seen is a value at risk. That is the difference in the way in which they maintain the value at risk, the way in which they calculate the value at risk is something which impacts that. So that's something that we have seen already, right? Okay. Okay. Now, we have talked about so we have seen that from this the for the banking books, for the assets on the banking books, that VaR is nothing but the total loss that the bank can make, right? And when it's subtracting from the expected loss, what they are getting is the unexpected loss, and that's precisely what we have. Now comes the next question, right? So now comes the next question over here, that you are actually calculating the expected loss, right? Okay. So we have seen what the trading books are, what the banking books are, what is the difference between trading and a banking book. Now the next part is that we focus on is to calculate the market risk. So how is it? What are the regulations that would go in to calculate the market risk? How would I assess the market risk in this profile? So that's the part that we need to excuse me. That's the part that we need to talk about next, right? So over here, let's say I have the market risk assessment. So there are so over here the market risk assessment approach that I'm talking about. I'm trying to secure a capital charge against market risk, and we say that there are two types of approaches. So like credit risk in Basel, there are two approaches that we have over here. Number one is the standardized approach. The second is the internal model approach. Now, the standardized approach for market risk is a bit complicated, right? And so is the internal modeling approach. So what we need to do is we need to actually understand that how is it that they are done. So the first part is there are two broad approaches. So what we are trying to do is we are trying to create this market risk. We are trying to assess. So while we try to assess the market risk, we will be follow. So we are trying to assess market risk on the market risk capital calculation charges, and there are two parts. One is the standardized approach. The other is the internal model approach, and we'll start off with the uh, overview of the standardized approach first, right? And when we start off with the standardized approach, now what we are going to see is that how does the capital, how is it that the capital charges are priced over here? So that's the part that we will try to see, right? Okay. Okay. Now this is the part that we talk. Market risk assessment. Assessment approaches. Okay. There are two broad approaches to assess market risk. Two broad approaches under the BCBS framework assess market risk. Under BCBS framework to assess market risk. The first is the standardized approach. The internal model. Now, this standardized approach is so they are known by the same name in both the BCBS regular for credit risk as well as in market risk. Now in the BCBS for the credit risk document, we talk about the internal. So we don't talk about, so we don't see the internal model of it. We say that it's the internal or the advanced internal rating based approach. So that's what we talk about. So this is what we have is standardized approach. The next that I have is the internal model approach. Right. So let's first of all try to define what the standardized approach is. So basically, we'll first start off with the standardized approach. In a standardized approach, like in an AIRB model, there are external ratings, right? So over here, the calculation is done as a sum of the capital charge calculation is done as a sum of three components. First is a risk charges under the sensitivity based method, right? Then there is a default risk charge, and then you have a residual risk add-on. And each of these components pertain to a particular source of risk on the asset, and each of those needs to be modeled, or they need to be captured through a model, right? So that is the part that we want to look at. Right. So let's start off. So basically, what we'll start off with is the standardized approach. Right. So we'll talk about the three key sources of risk that is there, and we'll talk about what those risk sources are. Right. How are they represented? What type of a risk do they reflect, and how is it that they can be modeled? So that's the part that we talk about over here. Right. So let's start off with the standardized based approach. The standardized approach of this is so over here what we have is the standardized talk about the standardized approach of calculating of market risk assessment under the BCBS under the BCBS under the BCBS. Now this is something that we want to study. Right. So let's try to understand what this standardized approach of market risk assessment talks about. Now, the objective of this market risk assessment is to calculate the capital charge, right? Says the standardized approach. So the standardized approach, the capital requirement calculated by the standardized approach is the sum of three components. Is the simple sum of three components. Number one, the risk charges under the sensitivity based model. The sensitivity based the risk charges under the sensitivity based model. So there is a sensitivity based method that we will talk about. Right. The second is the default risk charge. Finally, what we have is the residual risk add. Now, so over here, the first thing is the risk charge under the sensitivity based method. So under the sensitivity based method, we try to calculate what is the risk charge. Now to that I am adding a default risk charge, and after that whatever the residual is left, whatever residual risk is there, I am adding that risk add-on. So the sum of these three is the amount of capital that I need to keep aside for market risk under the BCBS guidance. Right? So now the next question is that we need to study each of these components, right? So one also, the risk charges under the sensitivity based method is the delta, right? The default risk charge is the vega, and the third is the curvature. Third is the curve. So these are the three sources of risk that we generally talk about, right? So the next part of the discussion is to start off with these three parts of the risk. So these are the three uh, sources of risk which is used to calculate the capital charges, and what we need to do is we need to add these three together to calculate the default risk charge, the curvature, and the right. So these are the three sources of risk that we have, that we need to calculate, that we need to estimate, and thereby calculate the capital risk charge against the standardized approach. Right? Okay, so let's take a pause here for the day, and let's regroup tomorrow, and we'll start off with this standardized approach of calculating the risk assessment under the BCBS guidelines. Okay, so good night. And Swastik, so what we'll do is we will do this session today. We did the session today, we'll do it tomorrow, and we'll do it on Saturday. So Saturday session may be from 3 p.m. to 5 p.m. Sure, I'll update you on this. Thanks a lot. Good night.